Have you ever wondered how tiny differences in investment fees can impact your long-term wealth, like how small ripples can turn into big waves? Making informed choices about where you put your money is key to reaching your financial goals, and understanding costs is a great place to start. The cost differences for exchange-traded funds, or ETFs, versus mutual funds primarily stem from their fundamental structure, how they are managed, and their trading characteristics. Generally, ETFs tend to have lower overall costs due to their passive management style and trading like stocks, while many traditional mutual funds, especially those actively managed, often come with higher expense ratios and transaction fees. The core reason behind these cost disparities lies in how each fund type operates. ETFs are typically designed to track a specific market index, like the S&P 500, meaning they are passively managed. This approach requires less frequent trading and significantly less research by a fund manager, directly translating to lower operational costs and a smaller expense ratio, which is the annual fee you pay as a percentage of your investment. Mutual funds, on the other hand, frequently employ active management, where a team of professionals constantly buys and sells securities to try and outperform the market. This intensive strategy involves substantial research, analysis, and higher trading volumes, all of which contribute to elevated management fees. When evaluating your options, consider focusing on two main cost categories: expense ratios and trading costs. To understand an ETF's expense ratio, simply look up its ticker symbol on your brokerage platform or the fund company's website. For mutual funds, you can also find this information, but be aware of different share classes that might have varying fees. For trading costs, ETFs are bought and sold like individual stocks, meaning they can incur brokerage commissions with each trade, though many platforms now offer commission-free ETF trading. Mutual funds may have loads, which are sales charges either when you buy the fund, called a front-end load, or when you sell it, known as a back-end load. An important insider detail is the concept of tax efficiency. Because ETFs are generally passively managed and investors buy and sell shares directly on an exchange, they typically generate fewer capital gains distributions compared to actively managed mutual funds. This often results in better tax efficiency for ETF holders, as you defer paying taxes on those gains until you sell your shares, letting your money grow for longer. By carefully comparing the expense ratios, potential trading commissions, and sales loads of ETFs and mutual funds, you gain a clearer picture of how much of your investment returns could be eroded by fees. Understanding these cost distinctions empowers you to choose investment vehicles that align with your financial objectives and help your money work harder for you over the long run, ensuring more of your hard-earned savings stay in your pocket.